In this video, I'm going to take you through everything you need to know about dividends, from what they are, when they get paid, how you can start getting some for yourself, and also some of the downsides too that beginners can easily fall into when starting to build out their own portfolio. Because let me just tell you this now, it's not just as simple as free money for nothing, but more on that one later. Dividends are just payments from companies back to shareholders. If you happen to own a company stock at the right time, you'll be entitled to receive a dividend, which will typically be in the form of cash payment right into your trading account platform. It's up to the company board to decide how much they want to pay and when they want to pay dividends. They can pay as often or as little as they like. In fact, if we take a look at some of the list of the largest companies in the world on the S&P 500, most of the companies listed here do pay some kind of dividend. And here at home in the UK, the vast majority of the FTSE 100 also pay some kind of dividend, making some of the companies here very attractive if you want to generate some kind of income from your investments. So how do you make sure that you actually get paid a dividend then? Well, it's quite simple, but we need to know about several key dates in a company's financial calendar. Let's use a real world example so we can follow everything along together. Tesco, the largest supermarket chain in the UK, is also a dividend paying company. So let's take a look at their last dividend payment to see how we would have also got ourselves as part of this payment. The first key date to be aware of is called the declaration date. This is the date that the company published the information to shareholders declaring their dividend, or in other words saying, we're going to give you a dividend, here's how much it will be, and here's the date that it will be paying it. In this example, Tesco's latest dividend declaration date was October the 6th, 2021. Inside the declaration information is effectively everything we need to know. The most important date to look out for is called the ex-dividend date. This is the date at which you need to be a shareholder to be entitled to that dividend payment. Even if you own a share in a company for a single day, as long as you own the company shares on the ex-dividend date, you'll be entitled to your payment. Make sure you own the shares before this date if you actually want the payment. Buying the shares on the ex-dividend date itself will not get you the current dividend payment. Following on from this, the next key date is the record date. In this example, you can see that for Tesco, this is the day after the ex-dividend date, and it is the day that all of the shareholders for the company are confirmed and recorded, meaning that they will all be received the dividend payment based on the amount of shares that they own. After this date, we're now getting toward the exciting bit, actually finally getting paid. This is known as the payment date, and for Tesco's last dividend payment was November the 26th. You'll see that there are usually a few weeks after the ex-dividend date to the actual date of the payment, and this is all perfectly normal. You could sell your shares during the time period between the ex-dividend date and the payment date, and you would still receive a dividend, because as long as you were a shareholder when the company went ex-dividend, then you are entitled to get that payment too. Now, how much you get paid depends on what is called the dividend yield, and this information is included in the declaration date. The dividend paid will be provided in figures showing how much per share that the company will pay. Quite simply, the more shares you have, the greater your payment will be, as this is a percentage number. In this example for Tesco, the dividend yield for their entire year of 2021 was 3.16%. For every share that was owned in 2021, Tesco paid the shareholders 3.16% of its value, which means that if you owned £1,000 worth of Tesco shares last year, you would have received £31.60 worth of dividends. Sounds good to me. Depending on which Apple platform you use, you might get an email about your dividend being paid for you, or it might just return up into your account in a cash or an income section, somewhere like that. So look out for this if you're wondering where the money actually goes. What you then do with that money is completely up to you. You might want to reinvest the money and buy some more shares. So if you have enough, you can go ahead and do that again, depending on the platform that you're actually using. Some platforms even allow you to automatically reinvest, so look out for those ones too. If you want some help looking at the best apps and platforms to use, please see one of my latest videos where I look at some of the best platforms for 2022 and beyond. All the links will be in the description below. So we've just covered off what dividends are, how they get paid, but now we need to address the elephant in the room and discuss some of the negatives. Firstly, remember that dividends aren't free money. Well, they might be for you when you get paid, but the money is coming, hopefully, from a company's profits. Once a company pays out a dividend, the value of the share price will typically drop to the same amount, as you are effectively taking cash out of the company and reducing its value. Imagine selling your house and also saying there's a briefcase of cash in the shed worth £5,000 included. The price of the house would include that £5,000 into its overall value. But let's say all of a sudden you say, sorry, that's no longer there. The value of the house would drop by £5,000. Shares work in exactly the same way. That's the best example I could come up with. One other thing to be aware of, and it's probably the biggest trap you can fall into in any point, is the dividend yield trap. As we've just discussed, Tesco paid out a dividend of 3% in the last year, which is about average, nothing special. But there are companies out there who have paid a lot more previously and continue to pay more, even above 10% of their share price. However, remember that a dividend yield alone is not the only thing you need to keep an eye on. Let me give you an example of a really high-paying dividend stock, British American Tobacco. No guesses for what this company sells, it's one of the largest in the world in this sector. Their current yield sits at a very healthy 7.59% based on the last 12 months of the share price. But just take a look at the share price over the company for the last 5 years. It's negative 30%. To put this in perspective, the S&P 500 has done over 110% in the last 5 years, more than doubled in value. So while you might have been making a dividend each year with this company, the overall value of your capital has been falling. So this is really, really important to take into consideration. On the flip side, a company which has done really well that pays a dividend might be someone like Diageo. The alcoholics drink giant has seen its share price rise by nearly 100% over the last 5 years, whilst also delivering a dividend which currently sits at 2.3% looking forward. So just be really careful when looking at companies. The yield is important, but so is the health of the business. How much cash do they have? Can they afford this dividend? And are they using profits to pay them, or are they being too risky and using debt or even issuing shares? One useful tip here is to look out for something called the dividend cover. This is the percentage of a company's profits that are paid out as the dividend. The more a company can cover its dividend, the better. So you want to make sure that you're over a ratio of 1 and ideally above something like 1.5, meaning that a company could pay its dividend 1.5 times and still have cash left for safety. As we all know, anything can happen in this world. There's a couple more major considerations too, which we need to discuss with dividends, and this comes down to taxes. As we've already said, nothing is free. In the UK, we've got a dividend allowance per year per adult, which currently stands at £2,000 per tax year. That means that you are allowed to earn £2,000 of dividends each year before you owe the taxman a penny. Now, for most people, this won't be an issue because you earn £2,000 of dividends. You probably need around £50,000 in your account, assuming you get paid 4%, which is around the average for the FTSE 100. However, it's worth being aware of if you are trying to build a portfolio over the really, really long run, because you don't want to have to pay taxes every time before you take cash out or make a reinvestment. Don't forget to use your stocks and shares ISA here to make the most of your £20,000 per year tax-free investing allowance. Any dividends earned here will be tax-free, so this might be something worth looking into. Another point too on taxes, if you are looking to invest in any companies in the US, for example, just note that you will be looking at a dividend withholding tax, which is imposed on foreign owners of their stocks. This amount is 30% of the dividend, but it is reduced due to a tax treaty between the US and the UK, meaning that you will actually get half of that relieved, which means you will still have 15% of your dividend income withheld by the US government. It might not sound like a lot of money, but it will be worth taking this into consideration if you're comparing a US company with a UK one over the long run. Speaking of the UK though, the FTSE 100 has a long list of companies who pay out dividends, and the majority of companies on this list pay out dividends, with the average payment currently sitting around 3.6% at the time of filming. If you want some inspiration of companies to look at, please see one of the recent videos I did on my own dividend growth portfolio, which I started using Freetrade, based around UK companies. I'll leave a link in the description below for this one. It's worth checking out to see how I'm actually diversifying my own portfolio using UK headquartered companies. Outside of this, let me give you some more tips that you might find useful when starting your own dividend portfolio or looking into companies who pay dividends. One of the most important things, in my opinion, outside of the fact that a company is actually growing, is asking the question about how safe the dividend is. In other words, how consistently has the company paid out their dividend, and are they likely to keep on paying? This is important for a number of reasons, but firstly, if I'm relying on this income and then a company all of a sudden stops, this puts us in a very bad position as shareholders. Luckily for you, you don't have to look too far for this information, and a lot of it has already been collected, and I'll share with you some great places where you can do your own research now. Firstly, look out for what are called dividend aristocrats and dividend kings. These are companies who've increased and paid a dividend for the last 25 years in the former and 50 years in the latter. In the US, where this group was coined, there are currently 65 companies in the S&P 500 which are part of the dividend aristocrats. That's a huge achievement when you consider all of the financial and economic challenges that we've faced over that period of time, which goes to show just how strong some companies are when things aren't going so well. For US data, there's loads of websites, but one you can use is something like suredividend.com, where they keep a spreadsheet updated for you. For UK companies, there's a great resource that I often use called dividenddata.co.uk, where you can look through all of the information you could want about company dividends in the FTSE 100, the FTSE 250, and other small cap stocks. You can trawl back through all of that data, go back in time and look at all of the historical information before making a decision on what companies you might want to invest in. Looking at a couple of examples, if we go to the dividend history section and look at the FTSE 100, and then filter this table by years of consecutive dividend growth, we can see that there is a great selection of companies here who have consistently paid a dividend and increased it for over 22 years, which is a phenomenal achievement. Names on this list include National Grid, DCC and Diageo, and we'd already name dropped earlier in the video. Anyway, that's one place that you can go and check out when you've got the time a bit later on. Outside of this, let me just give you one more tip. If you're still daunted by the thought of trying to pick and choose companies to invest in that pay dividends, and worried about that you'll make a mistake or don't know where to start, then you do have one more option. You could use ETFs, exchange traded funds, which already contain a selection of dividend paying stocks for you. So all you have to do is own that ETF and get your income paid to you through your ownership in this. One you might want to take a look at could be the iShares UK Dividend UCITS ETF, which can be found with the ticker symbol IUKD on your favorite trading platforms. Remember, I've covered some of my favorite platforms in a recent video, which will be in the description section below. Now, this ETF invests in some of the best UK companies for dividend returns and growth, and has an expense ratio of 0.4%. And you can find all of the information you need on their fact sheet and key investor information. I don't currently own this stock or have any bias here with this one. This is just an example that I'm aware of. Anyway, I really do hope you found the video useful. Drop me a like if you have, subscribe for many more. I'll see you guys in the next one. Check out this next video. But as always, happy investing.